All right, let's get right into it. We're going to peel back the layers of the Indian stock market today, because it turns out it has a really unique personality. And I'm not just saying that. A super detailed academic study found some pretty wild, unwritten rules that make this market, well, truly one of a kind. So you might think a stock market is a stock market, right? But is that really true? While a lot of global markets seem to share the same financial DNA, some, like India's, have their own quirks, their own distinct traits. And if you want to understand the market, you absolutely have to understand those traits. So here's our game plan. First, we're going to talk about what a market's personality even means. Then, we'll see where India looks just like every other market. After that, we get to the juicy stuff, the 3 unique rules that set it apart. Then, we'll turn all that theory into a practical playbook for investors, and we'll wrap it all up with the one big takeaway you need to remember. Okay, first things first. To really get what's going on, we need to understand how economists even figure out a market's personality. They use this tool called Stylized Facts. I know, it sounds kind of dry and academic, but stick with me, it's actually a pretty simple idea. Think of it like this. Stylized facts are the market's financial DNA. They're these recurring patterns and behaviors that keep popping up again and again, no matter which stock you look at or what year it is. They're basically the unwritten rules of the game. And this isn't just, stuff for a textbook. These facts are the absolute bedrock for building financial models, for managing risk, for coming up with trading strategies. I mean, if your model doesn't get these personality traits right, it's not reflecting reality. You're basically flying blind. Now, before we get to all the surprises, we need to set the stage. The study confirmed that in many ways the Indian market walks and talks just like the big developed markets around the world. It leaves some very familiar footprints.
For example, you see things like volatility clustering. That just means that chaotic, high-risk days tend to clump together. When it rains, it pours. It also has heavy tails, which is a fancy way of saying massive, out-of-the-blue price swings happen way more often than you'd expect. And yeah, over the long haul, things start to look a bit more normal, like a bell curve. And finally, when there's a big shock to the system, the market remembers it for a long, long time. So far, so normal.
But, and this is where the story gets really, really interesting, that's where the similarities end. Because the study also uncovered 3 major ways the Indian stock market completely breaks from the pack. It literally creates its own set of rules.
Let's start with the first plot twist. It's called gain-loss asymmetry. And what they found in India is the total opposite of what you see almost everywhere else in the world. So here's the deal. In most markets, big, scary price drops happen more often than big, awesome price jumps. That gives the data what's called a negative skew. But in India, it's flipped on its head. The research shows that large upward jumps are actually more common. That creates a positive skew. Now, if you're an investor, well, that sounds pretty great, doesn't it?
All right, on to the second unique rule. And guess what? It's another complete reversal of a standard financial idea. This one's called the leverage effect, and it's all about how prices and risk are related.
The textbook rule is simple. As stock prices go down, volatility, or risk, tends to shoot up. They move in opposite directions. But in India, no. The study found that volatility actually increases when prices are rising, so high returns and high volatility go hand in hand. That is a massive departure from the norm. And for our third and final unique rule, we have something that takes a shot at one of the core ideas of market theory, the idea of efficiency. The study found something called significant autocorrelation. In plain English, it means the market seems to have a memory. And get this wasn't just some tiny statistical blip. We're talking about 22 out of the 50 stocks in the NIFTY 50 index. That's almost half. For nearly half of India's biggest companies, past returns showed a real ability to give a hint about future returns. This just flies in the face of the famous efficient market hypothesis, which says the market is a random walk. This data suggests that maybe, just maybe, in India, it isn't. Okay, that's a lot of theory. So what? What does any of this actually mean for you, the investor? Let's translate all of this into a practical playbook and see what kinds of risks and opportunities pop up. Let's pull it all together. First, that positive skew, the fact that big gains are more common, that could mean the waiting time for a big pop in your portfolio might be shorter. Second, that reverse leverage effect, that's a huge warning sign. It tells us that chasing high returns in India means you are, by definition, also taking on high risk. And finally, that market memory, the autocorrelation, it suggests that momentum-based trading strategies might just have a better shot at working here than in other places.
So when you put it all together, the ways India is the same and these three huge ways that it's different, the conclusion is pretty clear. The Indian stock market doesn't just march to the beat of a different drum. It's playing an entirely different song.
And hey, you don't have to take my word for it. The researchers themselves said it perfectly. You just can't copy-paste financial models from the US or Europe and expect them to work flawlessly in India. The market's unique personality demands a unique approach.
And all of this leaves us with one big, fascinating question to think about. If India has its own secret rulebook, how many other major economies out there do too? It's a powerful reminder that in the world of finance, assuming that one size fits all can be a very, very expensive mistake.